Have you ever thought about investing, but felt overwhelmed by all the complicated jargon and options out there? You're not alone. Investing can be tricky, but once you know the basic rules, it can actually be a lot simpler. In this video, we'll break down 8 rules every beginner investor should follow, so you can start building your wealth, no matter where you're starting from. Let's dive into it. 1. Start early. One of the most powerful rules in investing is to start early. The earlier you start, the more time your money has to grow, thanks to compounding interest. The beauty of starting early is that your investments can grow exponentially over time, even if you don't have a lot to invest at first. For example, if you start saving for retirement at age 25 and invest $200 per month, you could end up with about $330,000 by the time you're 60, assuming a 7% return. But if you wait until age 35, you'll only have about $180,000. That's a huge difference. The key is to get your money working for you as soon as possible. Even if you can only invest a small amount at first, like $10 or $20 a week, it adds up over time. It's not just about having a big initial investment, it's about consistency. Starting early gives you more time to weather the ups and downs of the market, so you're in a much better position long term. The earlier you start, the less you need to invest to achieve the same results. 2. Invest as much as you can. The next rule is investing as much as you can. If you're able to invest more now, you'll have more wealth in the future. Simple math. The more you invest, the more you can earn in returns over time. For example, if you invested $5,000 per year for 10 years at a 7% return, that $50,000 would turn into $74,000 by the end of the decade. This rule doesn't mean you need to invest huge sums right away, but it's important to push yourself to invest as much as you can afford. Even if you're on a tight budget, small contributions can go a long way. The earlier you start, and the more you add to your investments, the faster your money will grow. Remember, consistency is key. Even if you start with just a few $100s, make it a habit to increase your contributions as you earn more. Investing regularly is much more important than trying to time the market or waiting for a perfect time to start. 3. Focus on long-term goals. The next rule is to focus on long-term goals. One of the biggest mistakes beginner investors make is focusing too much on short-term market movements. The market can be volatile in the short term, but if you stick with it over the long term, you'll generally see positive returns. The idea is to think of investing as a marathon, not a sprint. If you invest for the long haul, 20, 30, or even 40 years, you'll have the opportunity to ride out the market's ups and downs. Historically, the stock market has gone up more often than it has gone down, so if you invest and stay the course, you're much more likely to succeed. It's important to keep your eyes on your long-term goals and not get distracted by daily fluctuations. The best way to build wealth is by staying patient and letting your investments grow naturally. If you're focused on the future, today's market dips won't faze you as much, and you'll make more rational decisions. 4. Dollar cost averaging. Dollar cost averaging is a strategy where you invest a set amount of money regularly, regardless of the market's performance. It might sound simple, but it's incredibly effective. For instance, if you invest $200 every month, sometimes the market will be up and sometimes it will be down, but you'll always be investing, taking advantage of low prices when they happen. The idea behind dollar cost averaging is to avoid trying to time the market, which is something even professional investors struggle with. If you invest a set amount every month, you automatically buy more shares when the price is low and fewer shares when the price is high. Over time, this helps smooth out the effects of market volatility and reduces the risk of making bad investment decisions based on short-term fluctuations. For beginner investors, dollar cost averaging can also help make investing feel less overwhelming. When you set up automatic contributions, you don't have to worry about checking the market constantly. It's a set-it-and-forget-it strategy that helps you stay consistent and build wealth over time. 5. Use tax-advantaged accounts. When it comes to investing, using tax-advantaged accounts is one of the smartest things you can do. These accounts, such as 401(k), IRAs, and Roth IRAs, offer tax benefits that help your money grow faster by minimizing how much you pay in taxes. For example, contributions to a 401(k) are tax-deferred, meaning you don't pay taxes on the money you put in until you withdraw it in retirement. In the case of a Roth IRA, your money grows tax-free, and when you withdraw it in retirement, you don't pay taxes on the gains. These tax benefits might seem small at first, but over time, they can significantly increase your investment returns. If you're eligible to contribute to a 401k with a company match, you should always contribute enough to get the full match because that's essentially free money for your future. 6. Be aggressive when you're young. When you're just starting out with investing, being aggressive with your portfolio can help you grow your wealth over time. When you're young, you have the luxury of time, which means you can afford to take more risks with your investments. Stocks, particularly growth stocks and index funds, tend to have higher returns over the long run, even though they can be more volatile in the short term. The idea is that as you get closer to retirement, you can start shifting toward more conservative investments like bonds or cash, which are less volatile but offer lower returns. Starting with an aggressive strategy when you're young gives you the potential to build a substantial nest egg over time. The earlier you embrace the risk, the more you'll benefit from it in the long term, and you'll have the time to recover from any market dips. 7. Focus on index funds. For beginners, one of the best ways to invest is through index funds. These funds track the performance of the entire stock market or specific sectors instead of picking individual stocks. This gives you instant diversification, which is key to reducing risk. Index funds are a great option because they're low cost and passively managed. They don't require you to constantly monitor your portfolio or pick the best stocks. By investing in an index fund, you're essentially betting on the overall growth of the market, which has historically trended upwards over the long term. While buying individual stocks can be fun, it's hard to beat the consistency and simplicity of index funds. They provide exposure to thousands of companies across various industries, which means your money is more likely to grow steadily over time without the ups and downs of trying to pick individual winners. 8. Pay attention to fees and commissions. When investing, you want to make sure you're not losing too much of your money to fees and commissions. Every time you invest in mutual funds, ETFs, or stocks, there's a fee that you have to consider. These fees can add up over time, eating into your overall returns. Pay attention to the expense ratio of any funds you invest in. This is the fee that the fund manager takes for managing the fund. For example, an expense ratio of 1% means that 1% of your investment goes to the fund manager each year. That doesn't sound like a lot, but over the long term, it can make a huge difference, especially when compounding is at work. Choosing low-fee index funds or ETFs can help you keep more of your money working for you. Look for funds that track the market and have lower management fees to ensure that more of your investment is going into your future, not paying for someone else's services. That wraps up the 8 rules every beginner investor should follow to start building wealth. By following these guidelines, you'll be setting yourself up for long-term success and financial security. If you found these tips helpful, don't forget to hit the like button, share with a friend, and subscribe for more investment advice that's easy to follow. What investment rule has helped you the most? Drop a comment below and let me know. Until next time, keep investing wisely and building the future you deserve.